2064 on Canberra Live, 605512 or 60 if you have a financial problem, and this is your chance. Financial planner at Envision Financial, Luke Smith, away from the heat.
Well, it's awfully hot out there, I'll tell you. It was 41 rolling in and could have been 50.
Yeah, it could have been too, because there's not much difference, is there? Melbourne had 42 and a cool change came in and plunged 12 degrees in a couple of minutes.
Beautiful.
That's
I wouldn't mind a cool change. I'm not built for hot weather.
You can get cool in the you can get warm in the summer, but you can't get cold in the,
You know, the best thing is we've had a bit of feedback this week in the office, and evidently we might as well start calling that the cool room, because people open the door and it's like walking into a fridge. The girls have it that low that it's almost jumper weather. So it's awesome.
If you have a question for Luke, you can do it now, and don't forget there at 4452 Townsend Street, upstairs in the cool in Phillip, envisionfinancial.com.au. Today, asset allocation. Now, an asset is something you got.
Yep.
Okay. And an allocation is where you put it.
Bingo.
Is that right?
There you go. That's it. That's it in a nutshell. I'll hand the mic back to you.
No. So elaborate on that.
So asset allocation is the way that you try and mitigate or manage risk. So asset allocation is where do we invest what we're working with on a percentage basis to try and make sure that we maintain that old adage of don't have all your eggs in one basket. So an asset allocation is tied to your risk profile. Some people like risk, some people don't like risk. Some people don't mind just playing in the middle. And the asset allocation strategy is to say, how do you feel about risk? And then how do we invest the money in your portfolio that is in line with how you feel? So it's about breaking things up on a percentage basis to say, we might have this much cash, this much fixed interest, this much Australian equity, this much property, this much in infrastructure, this much in international assets. So we're cutting up the pie. If people think of a pie, it's asset allocation is how many slices of the pie do we have in different areas.
So it's only cash, it's only money we're talking about here? Or
well,
shares? What about shares?
Well, in totality. Right. So it could be listed property, unlisted property, Australian shares, managed funds, ETFs, all of the different vehicles that are available to us. But it's more about saying in what areas are we putting it. So you've got the product or the tool, that could be the share or the fund, but asset allocation is the broader diversification of the portfolio into different pieces of the pie.
So if I've got $100,000 in, is it combined assets?
Yeah, so when we think about the fund, if we take the example of if you've got $1 million in your superannuation fund, and you might say you're a balanced growth investor. Now that might mean that you want 60 to 70% in growth assets and 30% in cash and fixed interest. A bit more defensive in case things get a little bit bouncy. Right. You might then break that down into 30% Australian equities, where you might have bank shares, industrial shares, and different individual holdings. Then you might have 20 to 25% in the international sector. That might be America, it might be Europe, it might be Japan, it might be emerging markets. It could be a range of different things. Then you might have a property allocation. That might be listed property, it might be unlisted property, it depends on where you've invested. Then you've got cash and fixed interest. So you might have 1 or 2 years of pension money ready in the bank just in case. And then you might have 25, 20, 30% of the portfolio in defensive assets, and they might be income orientated. So we need to think about how we spread your risk and then what each individual sector does, and there's some of the things we're going to touch on today.
So the first thing you do is you've got to find out what your assets are.
Well, you need to know what your risk profile is.
Risk.
And I liken that to driving the car.
Okay.
If we're in a 100 zone and you drive at 40, there are implications. You might upset a few people, you might be late, you may get abused. There may be some tooting of horns. Let's liken that to cash and fixed interest. It's defensive, it's slow, and it's not going to grow. So if you're in a bit of a nervous Nelly and you think the world's going to end, that might be a larger portion of your portfolio. Right. That may mean you're a little bit more defensive. If you think you're a bit of a rock star and you want to drive at 160 Ks in a 100 zone, you'll get where you're going pretty quick.
Risk goes up, doesn't it?
Your risk goes up. If you think you can talk your way out of a ticket, good luck. But if you hit a tree, you may not get out of the car. Now that is high risk, high volatility investing. So in isolation, they're both as dangerous as each other because there are outcomes that are positive and negative.
Where's the Goldilocks in it?
Well, if you're in a 100 zone and most people say to me, well, I need two real things. I need growth to offset inflation and I need income to pay my pension and live.
Right.
So you might say, well, I'm a balanced growth investor, and that might be 50-50 growth and defensive. It might be 70-30. So we're not at either end of the extreme. We're then saying, okay, if we're driving at 100 kilometres an hour, I'm happy to do between 90 and 110. And that might mean you have 60 to 70% of growth assets and then 30% of defensive assets. So that's how you approach asset allocation, and then it's how you cut those sectors up to meet that 70% and 30% in totality.
Okay, you've got a house and a car, and you've got a few thousand in the bank.
Yeah.
Is that enough?
Well, when we think about asset allocation, we think about investable assets. So you can exclude cars, you can exclude houses. It's about saying, what resources have I got to generate the retirement income that I want to live from? And that could be assets in a company, assets in a family trust, assets in a superannuation fund. Shares. So again, that's more of a product as opposed to the allocation of where it goes. Because you can have a share in the Australian sector, you can have a share in the property sector, you can have a share in the international sector. So it's about saying, how fast do I want to drive the car? What's my risk profile? And then how do I diversify my portfolio relevant to how fast I want to drive the car? That's as basic
as...
as...
Smith, we were talking about owning 200, the ASX 200 if you wanted to.
Look, exactly. So we've talked in previous shows about using exchange traded funds. Exchange traded fund is a product or a vehicle that could be in either of those sectors. So I think the big thing for people is understand your risk profile to start with, and then try and work out how your money is invested.
And let me ask you there, you're talking about risk, you're talking about what do you want to gamble with?
Well, how do you want to manage volatility? Let's say the same thing a different way. We're not avoiding tax, we're mitigating costs.
I suppose that's the way to put it.
For anybody at the ATO listening. So it's really about saying, well, what am I trying to achieve? If you want a more defensive slant, then have a greater proportion of defensive assets. If you need strong income and some growth to offset inflation over time, then you might want slightly more in the growth sector. Now, there are some variances there, and we'll talk about that in a second. But
is it a matter of saying, okay, what can I afford to lose if things go bad?
Well, I would look at it more and say, how would I feel if the value of something changed? Because until people have gone through some times of volatility, I don't think people truly understand how they feel until they look at something and go, it's gone down that much. And that doesn't really matter where you invest. There's going to be different economic events that will affect the value of portfolios. We need to come back to say, what are we trying to achieve and what's our time frame? If we've got 5, 10, 15, 20 year plan, let's not throw the baby out with the bathwater because the market's come off over the last 5 months.
Okay.
We need to keep it in perspective.
Luke Smith, if you'd like to talk to financial planner at Envision Financial, do it now, 6255 1206. Super comes into this too?
Oh, exactly, exactly. So again, it's about saying, what am I working with? And then how can I manage my risk? And your asset allocation is how you cut that pie up into different slices, and each slice is a different area of the available market.
Not necessarily equal slices?
Not necessarily. Again, depends on how you feel about risk. You might have 30% international and 12% property. You might have 8% property and 35% Australian equity. So everything's about tailoring to how you feel, because my perception of risk in my time frame may be different to yours.
What happens if you hit a hurdle in your life and you need some?
Well,
can you take a slice of the pie?
But again, that's part of the strategy of saying, well, if I had, for example, if I'm a retiree, we generally always try to keep 1 to 2 years of future pension money in cash. So if we do have a GFC-like event and the value of things comes off, we've already pre-planned for that and said, okay, we've got 2 years minimum for this to recover before we need to worry about selling any sort of asset to maintain the lifestyle that you want. So that's part of your asset allocation strategy, to say, well, how much cash do I keep?
Yeah, because a dollar is a dollar is a dollar, isn't it?
True.
It doesn't go down or up in value. It's still a dollar no matter what happens. But your super can go up and down, your shares can go up and down, your equity can go up and down outside of a bundle of cash, can't it?
Correct. So again, thinking about what you're going to need in your time frame. People who are working and can't access their super may not need as much cash. If you've retired and you need that income to live, then keeping 1 or 2 years pension income in cash is again building in some backup strategies and some contingency plans, because the value of things goes up and down, and as we say, you eat income, you don't want to eat capital.
True.
So you can mitigate that risk.
How does it impact your portfolio?
Well, I think that the biggest misconception about asset allocation is that a lot of people come in and say, well, I'm older now, I need to be more conservative. All I heard was, I'm older now and I don't want as much income. Because without the right growth allocation, it's very hard to earn an income stream of 3, 4, 5% that you may need to live on from the resources that you're working with. So again, everybody's different. But the misconception that, well, I'm older now, I need to be conservative. The next line I normally get is, but I want good income and I need some growth to protect the capital value of my money. So educating people on how you can mitigate those risks within a portfolio is really beneficial.
Okay, 5:45. Well, let's go back and just summarise it then, Luke Smith. What is asset allocation and how does it work?
So I guess the key points for people are different sectors perform different jobs.
Yes.
The next thing is understand what your objectives are and invest accordingly. Okay, if you've got a short time frame, maybe take a more defensive approach. If you have time, you've got the ability to benefit from short-term fluctuations with a long-term goal. Check your growth profile, because growth assets may or may not provide the amount of income you need to fund pensions.
Right.
So understanding what your sectors are doing are really important, and obviously making sure that you understand the profile. And this one's really important because balanced doesn't always mean balanced. Host Plus was voted best balanced fund of the year in 2018, runs a 90% growth profile. Now when I think balanced, if I break it down as simple as I can, I think seesaw.
Equal, yeah.
Equal, 50-50.
Yeah, flat.
90-10, not so much. So when you're comparing things, it's important to look under the hood, because balanced at 90% and balanced at 50%, which one do you think is going to win more often?
Yeah. How are you going to choose? What are you going to do? Balance the asset allocation. Asset allocation with Luke Smith, financial planner at Envision Financial. You can call him now, 6255 1206, or at the office in Townsend Street in Phillip, 6260 4749. First call, first visit, no charge at all, and you can go online and have a look at his work, envisionfinancial.com.au. 14 to 5. You can do it on 6255 1206 or the office on 6260 4749. Asset allocations. What should I consider when I'm looking at my asset allocation? Where do I come from? Where do I start?
I think first of all you need to think about, like I say most weeks, why?
Yeah.
What are we trying to achieve? Do you want growth? Do you want income? Do you want a combination of the two? Because different sectors provide different things. Property's a very good income provider, be it, when I talk property, I talk listed property, so commercial, Australian Real Estate Investment Trust or an AREIT. Australian equities, very strong in income, but also strong in capital, positive and negative. Right. So banks are a good example. Very strong income stream. They're off 15, 20, 25% over 12 months because of the perception of the Royal Commission. International assets are growth orientated. So more capital orientated. Sure. So you put $1 in, at the end of the year it's worth $1.10, $1.20, $1.30. They provide 1 to 2% of distributable income. Okay, cash and fixed interest, 2 to 3 in the fixed interest space, and infrastructure, depending on where it's invested, could be a combination of income and capital. So understand what you're trying to achieve, and then understand the sectors that will give you what you want, because not everything provides good income, not everything provides growth. It's a mixed bag.
So you look to the future, you say, what do I want out of all of this pie that I'm putting into slices?
What am I trying to achieve? The next thing is, what's your time frame?
Sure.
How long have I got?
Oh, is there a time frame you should put on it?
Well, there isn't, but you should think about, well, if I've got 6 months or 5 years, your allocation may be different because you've got different volatilities, different tolerances, and you've got a need for capital at different times. So
you take a bit out of this allocation if
you
hit
quite possibly. Well, this is why you might say, well, I'll hold a little bit more cash just in case. So slicing up your pie is directly tied to how you feel about risk, how long's your time frame, and then what am I trying to achieve? Do I want income? Do I want growth? Do I want capital security? Maybe you have more fixed interest assets because they're less volatile. Maybe you say, I'll throw it to the wind and have a huge amount of growth assets. Just accept that you're going to have a greater volatility in times of uncertainty.
Yeah, and whether you want to sleep at night or not.
Well, you can't eat takeout 7 days a week and then complain you put on a few kilos.
No, that's true.
And this is very similar. You have to take into account your risk profile, not what other people do, because everybody feels differently. A lot of people say, well, what does he do? Well, it doesn't matter what he does, because you've got to be able to sleep at night with what you've done.
Depends on the pie you want to eat.
Correct. And then you should also think about how funds are invested. Do I have active investments? Do I have passive investments? The ETFs that we spoke about last week are a good example of a passive investment. it replicates the ASX 200, equities, property, S&P 500. You might then have some specialised active funds. So understanding what's under the hood and then how you break up your pie and then what goes into each section of those pie, there are the intricacies of planning for individuals.
So think about asset allocation, think about the pie, think about the future, but do your homework, and you can contact Envision Financial to 62604749. The acronym of the the acronym of the week is IRR. It sounds like something Irish. What is it?
Yeah, so IRR stands for internal rate of return. So that's generally a measure used to look at the performance of a pool of assets, taking into account money in and money out over a specific time frame. So if we look to say, what's the portfolio done over the last 12 months? The internal rate of return is a measurement of the collective performance of what's in the pie.
Right. Okay, so do that. Now, I've always said along the way, and this is advice that you should adhere to, seek advice from a financial planner. Luke, if you're going into these uncharted waters, you want to know you've got someone. And you've got a great example of that happening.
Yeah, look, I've got to give credit where credit's due, and it's all about sort of rewarding people. We'll change his name to protect the innocent. We'll call him Shane.
Okay.
He came to us 12 months ago, not knowing what a budget was, not knowing how to manage cash flow, not knowing how to save and build assets. And we caught up a week or two ago, running up to 12 months. And he's got himself significantly in front of where he was. He's taken on board the advice that we've given him. He's changed his behaviours and he's been consistent. And we said at the start, we take a slowly approach and try and build on things over time. Well, he came in last week over the moon, not just with the outcome that he's achieved through his understanding and learning of how to budget and sort of looking under the hood at his fees, charges and everything else, but we were over the moon that somebody 12 months ago didn't know what a budget was, and now he's almost turned it into a bit of a sport and challenges himself and sort of refines what he does every week. So, those moments are the best for me.
They're the victories, aren't
they? They really are. And someone can come in unsure and frightened in a way to leaving in control and feeling empowered and having that peace of mind that, I didn't know the way forward and now I do, and he has the tools in his kit to keep building on the good work that he's done. Yeah. We're just like the bumper lanes of bowling. We just keep him on the path and he goes off and does his thing. And comes in more and more engaged and more confident about what's happening, which is...
Looks with Envision, it's like anything personal. If you confront your fears, they don't seem as bad.
Look, I think education is the tool, and I guess that's why we're here, to try and educate people in clear and concise ways so that they can learn about what they don't know and then build on what they can do going forward, so that we can eliminate people coming in and saying, I wish someone had told me that 5 years ago.
Or yesterday would be better than tomorrow.
Well, you don't know what you don't know.
Yeah, now you've got a lot of access to what's the Knowledge Centre?
So we've got the Knowledge Centre on the website. We touch on this each week.
Yes.
There's free access to that. You can register online. That's a huge library of tools, calculators, videos, written content, and there are many different things that you can actually see on there. There's a risk profile tool. There's engagement tools, there's knowledge tools, there's little quizzes that you can undertake to see what you understand about different things. And look, that's if you want access to that, you can apply online, and they'll give you a period of time for free.
Yep.
If you then want to maintain your subscription, just touch base with me and we can make that happen as well.
Okay.
We're also about to launch a lot of the shows that we do on YouTube, because we've had a lot of feedback about how can we get material to get the key points out of the discussion. So we're building a library of that material at the moment, and from next week we're also going to have a little deep dive into a weekly vlog. So we'll talk about our topic this week, and then next week we'll delve a little bit deeper into what to think about, how to use it, what to review, so we can put a little bit more meat around it, because the feedback we've got is it's really good, but where could we go to sort of delve a little deeper?
There you go.
So we'll give people that from next week as well.
And if you'd like to contact financial planner and the team at Envision, Luke Smith and his team, they're good. 62604749, 4452 Townsend Street, Phillip. Learn more about Envision Financial on their web, on envisionfinancial.com.au. Happy Australia Day.
See you next week.